one of the things that we talk about a lot at Allied Wealth on the TV show, radio show, the podcast here, is, you said 4% rule. I use 5. All right. 4 or 5, right, wrong, or indifferent. But, if you've got $1 million portfolio and you're taking out 5% a year, your income is $50,000 a year, right? Plus Social Security if you're timing, and you should be timing it right. We'll talk about that again here in a minute. But, recently the market pulled down 10%, right? In the recent weeks here. Now we bounced pretty good on the last trade day of the week. Whether we're out of the woods yet or not is remained to be seen. But nonetheless, if you're, spending $50,000 a year by taking 5% out of $1 million portfolio, and your portfolio goes down from $1 million in a market decline of 20% to 800,000, which is very real and highly likely to happen over the course of retirement. All right. Your 5% is now $40,000. So your income went from $50,000 down to $40,000. And the thing that didn't change was your expenses.
Right.
Right.
Well, you may have to cut your spending. Yeah. And that's what economics says. It's very hard-nosed. If you've got lower resources, you got to reduce your spending in accordance to that, and you can't just put things on autopilot and say, well, the market will turn around, because it may not turn around. People on Wall Street will tell you that over any 30-year holding period, the market has done really well. And that's true. But if you ask how many independent 30-year holding periods do we have in the data, it's only 3. If you look at how the market did between 1929 and 1959 versus 1930 and 1960, those two results are basically the same numbers, because they have 28 years of the same returns in those two cumulative return calculations. So we only have 3 observations on separate 30-year holding periods in the U.S. market. If you go to Japan, if you invested in 1989 at the peak of the Nikkei, the stock market in Japan, 30 years later, you would be down 40%. The market didn't recover 30 years later. It's higher today, a little bit higher today than it was back in 1989, the Japanese market. But adjusted for inflation, it's actually 20% lower. So there's no guarantee that the stock market is going to come back. It's a terrific casino. I'm not saying don't invest in stocks. I'm saying it's a risky casino, and you want to be sure that I think people should have a living standard floor and just, play the market but not count on it. Let's put it that way.
Larry, that's really interesting. Is that what you're talking about is exactly how we design plans for our clients at Allied Wealth. Now, you're talking about using TIPS, Treasury Inflation Protected Securities, right, which are basically bonds that increase for a specific rate based on inflation over time. So your income is always increasing, right? Mm-hmm. We do it a little bit differently. What we try to look for is what's the product or program out there that I have to put the least amount of money into to get the most amount of guaranteed income for life. One of the things that's really nice when people, whether you hate annuities, you hate bonds or not, you have to come to the realization of exactly what a very, very astute economics is telling you here, that have your floor covered. No matter what, have your floor needs covered from some type of a guaranteed source, which a government bond absolutely is. So whether you use a guaranteed bond or use an annuity, have it covered. And a perfect example of that is we call it green bucket, red bucket, right? Your income for retirement should come from your green bucket. And it's going to come in regardless of what happens with the stock market going up or down. You're still going to have the same amount of income coming in. And then your red bucket we use, Larry, for growing, using equities to grow against inflation if we can. We can buy TIPS in that red bucket if we want to. We can also leave money for legacies and fun stuff and all that sort of thing. But the bottom line is the income you need is not coming from a volatile stock market. And I just think that our industry has done a very poor job of educating people out there that there's different ways of doing this stuff, which is why I'm so grateful to have you on the show today. Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.